Hey everyone, happy Thursday, March 21st. It's about 10:30 on the West Coast, and it's time for another market update. And it's a Fed week. The Fed Reserve concluded their most recent two-day meeting yesterday, and as expected, they did not do anything to the rate. They did not cut. They did not hike it. But like we've talked about, the most important part sometimes with these announcements is the press conference afterwards, the data they release, and that actually came in better than expected. Was well received by the markets. Where last couple inflation reports came in higher than expected. Job market's been so strong, a lot of people were worried that their tone that they in the press conference would be a lot more hawkish, a lot more negative for us. But actually, came in pretty good. And let's take a closer look at that. So the first thing, Fed Chair Powell, he was very enthusiastic about slowing down the tapering of their balance sheet. The Fed buys securities and mortgage bonds and things like that. They've been selling those off at a pretty high pace. That's not good for mortgage bonds, not good for the mortgage rates. So basically they're saying they're not going to stop selling them. They're not going to start buying, but they're going to taper that off, fairly soon. So maybe that happens in the May or June meeting, and that would be good for mortgage rates. So that was a good thing. And then Powell was very clear, almost adamant. He expects core PCE to get down, which core PCE removes food and energy prices. He expects it to get down to 2% over time, but he's not going to wait to cut if the job market starts to soften. So that was pretty good news. We'll get a little bit more into that here in a second. And then median forecast for all the different members is about 75 bips or 3/4 of a point in their Fed fund rate cuts in 2024. So that was a big number. A lot of people, that was kind of what was expected before this meeting. But like I said, with some of the data, people were worried maybe that would start to shift and more people would be less cuts for this year. But overall, it looks like, most of them are still on board to do, about three cuts for 2024, which is a good thing. The next thing, taking a closer look. So, talking about the inflation in core PCE, currently is at 2.85. So remember how this year-over-year number works. We're replacing a number from last year with a number for this year that either makes it go up or down. And Fed Chair Powell, he wants to get down to 2%. So like I said, we're at 2.85. We're expecting 3%, maybe the monthly estimate for February on March 29th. That's replacing 0.3%, so we come down a little bit. And as you can see, what MBS Highway did here is basically just populated 0.2 for each month as an inflation reading, which is a really good low number. But as you can see with the replacement numbers, by September, we're only down to 2.45. So we're still a half a point away from that 2%, target that the Fed keeps talking about. So it seems very unlikely we can get there, unless something changes. So, but keep in mind, the Fed has a dual mandate. They have to keep inflation low and they have to keep unemployment low. And like Fed Chair Powell said here a second ago, he's not going to wait until the job market softens. So, on that note, taking a look at this, what we found out yesterday in the data that the Fed released is that 17 of the 19 members see the unemployment rate staying between 3.8 and 4.1% in 2024, which is in contrast, the Congressional Budget Office, the CBO, has it at about 4.4% in 2024. So 17 of the 19 members don't think it will go above 4.1%. Right now we're at 3.9%. So let's just say it goes to 4.1 or 4.2. At that point, the Fed, their dual mandate kicks in. Inflation's still a little bit higher than they want, but unemployment's spiking. And that's probably where we're going to get a cut. So this is the most important thing to keep an eye on, probably, with inflation probably trenched kind of where it's at and hard to get to that 2.0% level. If unemployment spikes to 4.1 or above, that's when the Fed might take action and start cuts. And the reason that's important, as you can see right here, basically every time the unemployment rate spikes over 0.5% above its cycle low, within a couple months or already happening, we're in a recession. So going back to 1948, it was 9 months, but after that, it's, within the most 3 months later. So, the low was in April 2023 was 3.4. We're at 3.9 right now. So we're above that. So, that's why the Fed wants to make sure they don't want to go into recession. They want to have a soft landing. So they need to make sure they act before the employment spikes too much. So like I said, that's, we don't want employment to go up, but if we want rates to come down, that's probably what's going to have to happen. So, like I said, well received by the markets. That was all pretty good news, considering we were expecting worse tone from Fed Chair Powell in his comments. So next thing, February starts and permits were up across the board. Keep in mind, this is important for future inventory, future housing. So starts up now, single family, especially 35.2%, permits 29.5% year over year, single family completions 4.2%. Keep in mind, remember, permits is really important. This is our future housing number because they have to pull permits before they build anything. That's at 1.52 million. That's a good number. It's getting higher, but remember, current demand, household formations in this country is about 1.8, 1.9 million annually paced. So we're still behind, demand. So we're still creating more of a gap there. So good to see that gap closing a little bit, but as long as that gap is there, it's going to be price supportive, keep prices pretty high. And then the next thing we got was February existing home sales. So this was up 9.5%. It was expected to come in at negative 1.5%. That's a big gap, 11%. After a slow January, it's good to see those spike. And like I said, still down negative 3.3% year over year. Median home price up 5.7% year over year. Inventory, big spike, 5.9% month over month, now 10.3% year over year. So like we've talked about, sales have been down, existing home sales have been down, but there hasn't been a lot of inventory out there. So with inventory going up, we saw a big spike in sales, which is good to see. 2.9 months supply on the market. Remember, a normal market's about 4.6 months, so we're still a seller's market. And then, days on market, we got to keep an eye on this. This is, 38 days, which isn't too high, up from 36, but at one point not too long ago, it was at 22 days. So we got to keep an eye on that. Sold over list price, still at 20%. First-time home buyers dropped a little bit. Cash buyers, investors went up a little bit. So overall, good to see, like I talked about, inventory went up and sales went up. And that's kind of something we've talked about over the last year with so little homes for sale out there. It made it really hard for there to be any sort of activity on the markets. Next thing we got, initial job claims, still really slow. We just talked about unemployment, but keep in mind, initial job claims is usually the last thing that's going to happen in the cycle. People get laid off, then there's a gap, then people apply for unemployment. Expect to be about 215,000, came in at 210,000. Miscellaneous stuff. I'm not going to go too in depth this. I don't have enough time today. If you're a realtor, you should talk to your principal broker about this. But obviously, NAR, the National Association of Realtors, did settle their lawsuit that they had going on, relating to buyers' commissions. And there's a lot of talk in the media about this, a lot of negative talk. I'll just say, like I said, talk to your principal about this. And if you're a buyer or seller, you're watching this, buyer's agents are very, very, very important. I don't like that this might pass off some, cost to the buyer in a time when it's really expensive for buyers to purchase. But like I said, I think this is a little bit more negative than it needs to. And as like I said, I'll probably do a video upcoming, maybe in next week's video, or maybe a separate video, going a little more in depth about this. Average 30-year conventional down to 6.96, 7.02 last week. Nice to get below that 7% number. Would be really, really nice to get below that 6% number. But like we talked about, we're going to need, basically unemployment to spike a little bit higher, probably to get where, we're going to see that happening. Next thing, so important dates, we got PCE next Friday, that next look at that inflation number. Lower that is, the better it is for us. BLS jobs number, that's where we're going to get that unemployment number that first week of April. So we're going to have to keep a very, very close eye on that. Then another inflation report, and then the Fed's not meeting again until May 1st. That's the next chance for them to lower the rate, raise the rate, whatever they're going to do. So like I said, good to see, what happened this week. Good to see that the Fed is aware that, even if inflation stays a little higher, they're still willing to cut if unemployment jumps. But like I said, nice to see some positive movement, get down below 7. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, hope you guys have a great week. Thanks a lot, guys.